Most e-commerce founders are great at growing revenue, but terrible at planning for what they'll owe on it. The brands that scale sustainably aren't just good at making money, they're good at keeping it. And that starts with proper tax planning. Now, you didn't start an e-commerce business to become an accountant. You started it to build something, to create freedom, to scale, not to be doing all of your bookkeeping and tax planning. But here's the truth that nobody tells you. Freedom doesn't come from revenue. It comes from keeping what you make. So in this video, I'm going to show you the 5 tax systems that separate brands at scale from brands that scramble every April, and why most founders wait until it's too late to install them. Now, if you'd like to get a free case study training on how we actually scaled to 8 figures with an exit in 2019, be sure to comment the words case study down below. Now, here's what I see happen over and over again in the e-commerce space. A founder launches a brand, year 1 goes well, year 2 may even be better, but by year 3, they're doing 7 figures. Now, revenue is growing, products are selling, the business looks healthy from the outside. But unfortunately, April comes each and every year, and that means taxes come. And they realize that they've been sitting on cash that they actually owe to the IRS, whether they like it or not. Now, many times that can lead to owing 5 or 6 figures in taxes and not even knowing it, when there could have been a great plan throughout the year to help you avoid that problem. And so you may be thinking, not me, my tax firm down the road handles this for me every year. But the problem is generic tax prep and people will only get your taxes filed, where an e-commerce specialized team can help save you tens of thousands of dollars in deductions that you didn't even know existed. And here's what makes this even worse. There's a hidden cost to this mistake that goes way beyond the tax bill itself. I'm going to show you exactly what this is in just a few minutes. But first, you need to understand why this happens. Most founders are optimizing for the wrong number. They're watching revenue like it's the scoreboard. They celebrate every time they hit a new milestone, whether that's $100,000 in a month or $1 million in a year. But revenue isn't profit, and profit isn't cash, and cash isn't what you get to keep. And here's the reality of how e-commerce cash flow works. You make a sale today, the platform may pay you in 2 weeks, depending on which platform you're selling on. You then restock inventory next month for a 3 to 6 month cycle. Your ad spend hits your credit card 30 days later, and your tax bill, well, that doesn't show up until the following year. And so you're making decisions based on money that isn't really yours. You're reinvesting cash that you actually owe to the government, and you're scaling on borrowed time. And the bigger that you grow, the bigger that gap becomes. So here's the first belief that I need you to shift. Tax prep isn't an April problem. It's a year-round system. And if you don't have that system, you're not building a sustainable business. You're building a cash flow crisis that's waiting to happen. So let me show you the math that most founders miss. Let's say that you're doing $2 million a year in revenue across Amazon and Shopify, maybe some other platforms as well. Well, after all costs, your inventory, your ads, your fees, your software, your team, you're at a 15% net margin. That's $300,000 in profit. Now, your effective tax rate between federal, state, and self-employment tax is roughly 30 to 40%. That means you're going to owe approximately $105,000 to $120,000 in taxes throughout the year. So here's the question. Do you have $120,000 sitting in a separate account right now, untouched, waiting for tax time? Most founders don't. Because here's what actually happens. You see $300,000 in profit. You think, I can reinvest this. I can buy more inventory. I can scale my ads. I can finally hire that operations person. So you do, and it works. Revenue starts to grow. But that tax bill, it doesn't go away. It actually grows with you. It becomes a bigger and bigger problem if you aren't being forward thinking and planning for it. And look, I get it. As stated at the beginning of this video, you didn't start an e-commerce business to become an accountant or bookkeeper or tax person. You started it to build something, to create freedom, to scale. But here's the truth that nobody tells you. Freedom doesn't come from revenue. It comes from keeping what you make. And there's a specific reason why most e-commerce founders get this wrong. It has to do with how different your business is from traditional retail and other service businesses. I'm going to break that down in just a minute. But here's the hidden costs that I mentioned earlier. When you underpay your quarterly estimated taxes, you don't just owe the tax. You also owe penalties and interest on top of it. The IRS charges interest on any underpayments. And if you're significantly under, there's an additional penalty. So that $120,000 tax bill, it can easily become $135,000 or more if you didn't plan properly throughout the year. That's an additional $15,000 gone for poor planning, not because you didn't make money, but because you didn't have a system. The brands that scale sustainably treat taxes like a supplier payment, non-negotiable, built into their operations from day one, not as an afterthought that they have to pay in April. They plan for it. Now, here's why e-commerce makes this problem even worse. Traditional retail businesses have predictable cash flow. They sell in a store, they collect cash, they know their margins. e-commerce, it's completely different. You're selling on Amazon, Shopify, maybe Walmart, maybe TikTok Shop or other platforms. Each platform has different structures, whether it's fee structures or payment schedules or refund policies, even advertising costs. Amazon might be 12% net margin after all fees and your pay-per-click ads. Shopify might be 22 or 30% because you control the customer experience and there's no referral fee. Walmart might be 8% because of their fee structure and some lower price points that you have to do to tailor to the Walmart customer. And so if you're just looking at total revenue and total profit, you have no idea which channel is actually making you the most money. And when tax time comes, you're guessing at what you actually made. This is why generic tax prep fails e-commerce founders. Your CPA or accountant or tax team needs to understand, first, how to categorize FBA fees versus referral fees versus storage fees. Second, how inventory accounting works across multiple channels in multiple locations around the country or even around the world. Third, what e-commerce specific deductions you're missing. Fourth, how to handle returns and refunds properly. Now, you can't plan for taxes if you don't know what you actually made, and you can't know what you actually made without clean bookkeeping that reflects the reality of multi-channel e-commerce. And so before I move on to the 5 systems, if you're interested in booking a call with our expert team of e-commerce bookkeepers and income tax specialists to help you set up these systems in your business so you don't have to worry about the constant day-to-day grind of doing this, then check out the link in the description below. You can schedule a time with our team. So what's the solution? It's not one thing, it's 5 interconnected systems that work together. So let me walk you through exactly what we recommend with every e-commerce brand that we work with. System 1, quarterly tax planning. Now, here's how most founders operate. They wait until April, they hand everything over to their CPA, and they hope for the best. And here's how sustainable brands operate. Every 90 days, they estimate with their tax team what they'll owe. They set aside money before they spend it. This isn't complicated. Every quarter, you answer a few questions. First, what did we actually make in profit this quarter? Second, what's our estimated tax obligation on that profit? And third, how much do we need to set aside right now to be able to handle that tax obligation? You don't wait until the end of the year. You don't guess. You start to make plans for things that you can write off to help reduce that tax obligation if possible. You calculate, you set things aside, and you avoid surprises and penalties. And so you might be thinking, what if my profit fluctuates month to month? Well, that's perfect. That's exactly why you do this quarterly and you don't do this annually. You adjust as you go. If Q1 was strong and Q2 was weak, you adjust your estimate. You're not locked in. You're staying ahead. You can forecast that maybe your fourth quarter is going to be much higher because that's what it's done every year prior. And you start to set aside a little bit more money for taxes, knowing that that's going to be a big hit in the future. The goal here isn't perfection. It's having accuracy directionally and avoiding having an April scramble where you're having to pay for taxes and interest. Now, system 2 is clean bookkeeping that actually reflects reality. Now, this is the foundation that everything else is built on. You need to track profitability by channel, not just total revenue and total expenses. If you're selling on Amazon, Shopify, and Walmart, your books need to show revenue by platform, cost of goods by platform, advertising spend by platform fees by platform, and net profit by each platform. This isn't busy work. This is how you understand your real numbers, not just your revenue. And clean bookkeeping means that every transaction is categorized correctly, every platform is reconciled monthly, every expense is tied to a category that your team can actually use for deductions, inventory is tracked accurately across all channels, and when your books are clean, your team can maximize your deductions. When they're messy, you end up overpaying. And here's what most founders don't realize, that clean books give you confidence. You want to have these every single month by a certain date each month so you know when you can review them, you know how you can best forecast for them, and you know how to best do some tax prep. You want to be able to look at your P&L or your dashboard and know exactly where you stand, where you can make decisions based on real data and not a gut feeling. You can scale without having fear that in the future, the tax boogeyman is going to come out and get you. Now, system number 3 is having proper separation of business and personal finances. Now, this is simple, but most founders get it wrong from the get-go. You may be one of them, or maybe this sounds far-fetched to you that anyone would ever make this mistake, but I've seen it happen time and time again, where the founder has one bank account and they have one messy tax return. I've seen founders running million-dollar businesses out of their personal checking account, where every business expense is also mixed with their personal groceries, with their mortgage payments, with their personal subscriptions. And when tax time comes, their CPA has to sort through hundreds of transactions, or thousands in some cases, trying to figure out what's deductible and what's not to mention the potential legal issues that could come up from having your personal and business finances mixed. So the result here is missed deductions, overpaid taxes, and a tax return that takes 10 times longer than it should. And so here's the simple fix. Make sure to have one business checking account for your operations, have one business savings account to set aside for taxes, one business credit card for those expenses, and keep your personal expenses completely separate from your business expenses. That way, every time you take a profit out of the business, you do it as an owner's draw or a distribution. It's clean, it's documented, it's defensible. This makes it really easy for your CPA to be able to save you money, see where things are being missed, and how you can best prepare for your taxes. And it protects you if you ever get audited. So system 4 is setting up strategic tax prep with e-commerce expertise. Now that's the kicker. That's the important part, is the e-commerce expertise, because we all know e-commerce is extremely different than typical businesses. Because here's what drives me crazy. Most CPAs don't specialize in e-commerce. They're great at tax prep for traditional businesses, but they don't understand the nuances of multi-channel selling, of FBA inventory accounting, of platform-specific fee structures, of e-commerce specific deductions. Ultimately, you need to remember that a generic tax person will get your taxes filed. An e-commerce specialized team, however, will save you tens of thousands of dollars in deductions that you didn't know existed, as long as that's available for your business. Things like a Section 179 deduction for equipment and software, or a home office deduction structured correctly for e-commerce if you work out of your home. There's so many things that go into an e-commerce business that is different than traditional retail or traditional businesses that you need a tax specialist to be able to help you with. The right tax prep doesn't cost you money. It saves you money, often more than it costs. Now, generic tax prep misses e-commerce specific deductions. The right team pays for itself in savings and in peace of mind. And so system 5 is the cash flow systems that include tax obligations automatically. Now, this is the system that makes everything else automatic for you. You need to automate your tax savings so that you never have to think about it. Here's how it works. Every time money hits your business account, a percentage automatically transfers to your tax savings account. So let's say that your effective tax rate is 35% for an example. Every time that you get paid, you can take your revenue times your average profit percentage times your effective tax rate and put that into a separate account. Or what's maybe easier is you can actually figure out a good average. So if your profit margin is typically 20%, then you would take your 20% times your 35% tax rate, and that gives you a 7% that you need to take out of your gross sales every month to set aside with every single disbursement for your taxes. Now, the beauty of this is that you can just set this up once. It runs automatically and you never have to think about it again. Many banks will do this for you automatically just based on any incoming money, and then it takes the percentage and pushes it to a sub account. Now, remember that hidden cost that I mentioned at the beginning of this video? Here's the full picture. The most expensive mistake isn't underpaying your taxes. It's spending money that isn't yours and then having to scramble to cover it later, where you're taking out loans, pausing growth, or worse, you're going into personal debt to pay a business tax bill that could have been avoided had you planned properly. Now, when you automate your tax savings and you treat it like a supplier payment in this instance, you eliminate that risk completely. You build the cost into your operations from day one. It's not an afterthought. It's part of how you run your business. And here's what happens when you do this. You don't have any scrambling, don't have any surprises. There aren't any cash flow crises at tax time. You have clean books, maximized deductions, and the confidence that comes from knowing that your numbers are handled properly. This is what sustainable growth looks like. It's not just growing revenue, it's growing profit, and it's keeping what you make. The brands that win long-term have this dialed in. They're not smarter than you. They're not working harder than you. They just have better systems. Here's the reality. You have two paths in front of you. Path 1, you can keep doing what you're doing. You can hope that your accountant catches everything. You can hope that you set aside enough. You can hope that the IRS doesn't come knocking with penalties and asking for an audit. Revenue might grow, but so will your stress. And eventually you're going to be hitting a breaking point, either a massive tax bill that you can't pay or a cash flow crisis that forces you to slow down right when you should be scaling. Now, path 2 is you install these 5 systems. You treat taxes like a supplier payment. You plan quarterly. You automate your savings. You work with someone who actually understands e-commerce. Revenue still grows, but now you keep what you make, you sleep better, you scale sustainably. Sustainable growth requires systems. And tax planning is one of the most important systems you can install. So you might be saying, but I'm not doing $1 million plus yet. Do I really need to worry about any of this? Well, yes, especially if you're not at $1 million yet, because it's easier to install these systems at $300,000 than it is to fix the mess at $2 million when the cash problem is even bigger. And the habits that you build now are going to determine whether you scale smoothly or you crash hard later. Now, if you want help implementing these systems, and if you want a team that specializes in e-commerce, bookkeeping, and tax planning to handle this for you, that's exactly what we do at EcomBalance. We handle the quarterly planning, the clean books, the tax prep, all 5 systems for mid, 6, 7, and 8-figure e-commerce brands. Now, if that's interesting to you, check out the link in the description or comment case study down below to get our free case study on how we scaled our own business. But whether you work with us or not, please install these systems, because the brands that win long-term aren't the ones with the best products or the best ads. They're the ones with the best systems. decisions. And if you want more systems like this, operational frameworks, financial strategies, the stuff that actually scales businesses, hit that subscribe button right now. You didn't build this business to hand half of it to the IRS because you didn't plan properly. You built it for freedom, for impact, for the life that you actually want. The only thing standing between you and that life isn't your product, your marketing, or your competition. It's whether or not you have the systems to keep what you make. So install these systems, protect your profit, and build something that lasts. I'll see you in the next video.